Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. And this week clearly belongs to the metals which have posted hefty gains and have managed to hit multi-month and multi-year highs. If you start with zinc, that is trading at a 10-year highs. It's a third-year high for the copper prices as well. Aluminum as well is trading at a 33-month highs. And lead has charged on ahead on falling inventories and sanctions on North Korea. Remember, the US has put sanctions on North Korea, and that is where China imports maximum lead from, and those supplies perhaps will get hindered, and that is taking the lead prices on the higher side. To talk more about that, we are now joined by David Lennox of Fat Profits. David, hi, thank you so much for joining us. The metals have seen some profit taking, but every time we see a decline, there is a buying that has come back into this space. How are you looking at the sector at this point in time?
Look, at this point in time, we did see overnight a slight strengthening in the US dollar, and what that does is it does push those commodity prices lower. So we would suggest that we have, as you said, Manisha, seen a very strong rally in the broader commodity prices across the course of 2017 to date. So we wouldn't be surprised to see some profit taking come at some stage, especially, as you said, when we have a look at what's happening in the equity markets. We've seen the risk-off trades being minimised. And, of course, when that happens, we do see commodities react in the same way. So at this point, we are expecting perhaps to see just a wee continuation of the weakness in commodity prices. But as we start to move through and away from the events that have caused the equity markets to weaken, then we would expect to see commodity prices return to their trend. And that's been, through this year, higher.
David, the strongest fundamentals and the best price gains really have been seen in the zinc and lead prices, which have given the best performance as well. And this is after 2016, where we saw double-digit gains come in for both of these metals. Do you see a repeat of that performance even now?
Look, at this stage, we continue to like zinc and lead, primarily, of course, if you have a look at the inventories, especially in zinc, we are seeing those inventories trending lower, and they have now for some time done that. That's because there is already a deficit of supply in the zinc market. So that's why we're very supportive of zinc. If you have a look at the other commodities, copper and nickel, they aren't as yet in deficit supply, but they are moving in the right direction to get there, perhaps towards the end of this year, but certainly probably in 2018. So you then go back to look at their inventories, and those inventories have either been rising or remained fairly stable. So that would suggest to us that we are going to see further strength in the zinc prices, but perhaps if we look at copper and nickel, they may continue to trade they may continue to trade perhaps a step behind where zinc is trading.
So, David, as you pointed out, there is strong China data, the China infra spend. We've seen supply concerns, inventory declines on LME and Shanghai as well. And, of course, the US dollar has been weak. So would you say that all of this news now has been factored into the prices, or do you see much upside from here?
We would suggest that if you have a look at the remainder of this year, that there probably will be more good news to come, especially when we get towards the end of this year. We start to look into 2018. As I've already suggested, we do think that we will see key commodities such as copper and nickel probably moving towards more of a deficit supply than we see at the moment, and that will bode very well for commodity prices. Throw in the fact that we haven't seen inflation in 2017, but the factors that are driving that are probably still in play, and we think will be more so in 2018, and that again will be very good for commodity prices. So we will see volatility between now and the end of the year, but if we were looking into 2018 already, we would suggest that commodity prices have probably got a better time to come next year.
All right, good time yet to come when it comes to metals in this year and the next year as well. But David, what's your sense on the crude oil prices? Let's talk about that too. And we have seen some slippage in prices from the high 50s that we saw in this week itself. How are you looking at the forecast?
No, the reason for that is we've seen US domestic production now right throughout 2017 increasing. It's gone from about 8.8 million barrels of production of oil a day up to 9.5 million barrels the last weekly read that we saw. So there has been a major increase, and that increase has come on the back of the fact that we've seen domestic producers inside the US actually are cutting their costs, which brings down their marginal cost of supply. So as we've seen the oil price stage somewhat of a constant price of between $50 and $55, that brought back production into the US. We've seen that price now drop to just sub $50, but unfortunately at this stage we still haven't seen that US domestic production being taken out of the market because of the lower costs. So we do think that the oil price may perhaps struggle going into the end of the year. We have kept our $65 WTI price, $67 Brent price, but at this stage that looks as though it may be a bit of a struggle to get to. $50 would appear at this point to be where we're perhaps going to see the price settle.
All right, so consolidation around those levels. But David, before we let you go, how would you want to put your year-end bets? I mean, people are expecting gold prices to run up further from here. What would you want to choose between the base metals and the gold prices going forward?
Look, certainly we would suggest that the gold price will, when we get towards the end of 2017, we will be looking at 2018, and that inflation figure is going to be the one that the markets will again concentrate on. It hasn't arrived in 2017, but the factors are still there to push it, and we think that's going to happen in 2018. That's going to be a very good tailwind for the gold price, and we would suggest going into the end of 2017 that the gold price will be probably trading around $1,400. So a good rally from where it currently sits. The base metals, again, we've seen in the base metals, we've seen certainly development capital flying out of that market now for some years. And when we start to look at 2018, the supply deficit equation is certainly starting to swing towards supply going into deficits. And we do believe that that's going to bode well for commodity prices, again, as we approach the end of the year, and if not, certainly in 2018.
All right, David, we'll let you go at that on a very bullish note coming in from David Lennox, saying that the metal prices are expected to run up, but the gold prices, keep an eye on that. They could end this year around $1,400 per ounce. Let's talk more about gold in the global and the Indian markets then. And for that, we are joined by Surendra Mehta, who's National Secretary at India Bullion and Jewelers Association. He joins us in our studios. Mr. Mehta, hi, good to have you. First of all, a comment on the gold prices. What is your expectation? Are you as bullish?
Definitely, Manisha. I am also very bullish about the gold prices. But I think 1320 trions a dollar is a resistance level. And if that crosses, then only it will be heading for $1,400. But it needs to be seen whether it touches 1320 in the next 2 weeks or not. That is very important.
Well, add to that the rupee volatility as well, because the Indian markets will look at that too. But Mr. Mehta, there is more, pressing issues back at home, especially with the duty-free imports coming in from South Korea, and that has led to Indian gold prices trading at a discount. How bigger an issue is that, and how soon do you see it getting solved?
The issue is far bigger than we all of us think. In fact, there is a bilateral agreement with Asian countries. Now, these Asian countries includes countries like South Korea, Indonesia, Philippines, Cambodia, Thailand, many others. This is not only the matter of Korea. If the import of Korea is stopped, probably the import from some other country will start. And I think government needs to take some immediate action on this, because this is actually directly competing with the import of the banks. It is directly distorting the market. There is a huge disparity. There is a discount of about $10 to $15 in the market because of South Korea imports.
So what step do you think that the government could take onto this, and how soon? Do you see a quantitative gap coming onto this? Do you see a cess or a countervailing duty coming back? Because post-GSTs, as you said, this issue has arisen.
See, we need to understand one thing. All bilateral agreements have been entered into pre-GST regime, when the GST was not in place. But now there is a case of GST. Before GST, there was 12.5% countervailing duty on the import from these countries, which are free trade area countries. After GST has come into picture, this excise or countervailing duty no longer exists. Now it is for the government to decide. We have given various options such as cess on the GST with respect to import on this country. We have also said that for the time being, ban HSN code number 7113, 14 and 18, which is with respect to jewelry, articles and coins import from this country. That is another option. Or just have a level playing field by any other method so that there is no disruption in the market.
But ahead of festivities, what is your sense? If it doesn't get resolved, what is your sense? Are we looking at a weaker market here, or do you see preparedness ahead of festivities actually picking up, and this would just be one of those factors?
No, actually the market is always looking for the festival season, which is about to start in a week or so now. And definitely this import from South Korean countries are disturbing the market. There is a huge price disparity. See, basically the losers are the people who do ethical business, who are buying gold from the banks only.
But Mr. Mehta, tell me, the loss of course would be for the industry. How would that calculate for the consumer right now?
What you say is right, but basically if you see that the people who are importing this, they are getting almost 10% duty benefit. But if you see the market, the discount is only about 1 to 1.25%. So it's a net gain of about 8.75 to 9% to those people who have been importing these coins and articles from this country. So the whole market is not benefited. So the benefit is not going to be passed on to the consumer for the import from FTA countries.
Yeah, but keeping that issue aside, because that will take its own time, as you said, the government is still looking at all of those options. Coming up to the second point then, with the festivities starting, what is your sense? Is the buying going to come back? Because we did see a lot of buying pre-GST, and post-GST there has been a bit of a lull. Do you see that picking up in the next week onwards?
Well, definitely. Everyone has been waiting. The jewelry market specifically waits for the season to start, the festival season to start. It starts always with the Ganesh Chaturthi on 25th of August. And we are all looking for the good festival season. There is a Diwali ahead, Dashera, Diwali. All this will always see the good buying at all the levels. But price is also an important factor. If the price crosses 1320, then it is going to go up to 1400, and I hope that this does not happen before Diwali. Otherwise, there is going to be some restriction, some lesser movement of the customer in the market.
All right, Mr. Mehta, we'll let you go at that. Thank you so much for joining us. Really appreciate you making more sense on what's really happening in sense of the gold market in India. But with that, we'll take a very short break. When we come back, we'll talk about the monsoon and its vagaries. Remember, monsoon until time is 5% below normal. We'll get you more details on that.